in terms of when this ES triggered for us yesterday, now we're talking about breaking the 34 EMA low, the 50 DMA, or the 50 period simple, because we are on the daily chart. We saw the break right through there, and that is when we had the follow through, the sharp follow through in terms of one, the 50 DMA, two, the break at 1370. Let's not ignore how important that 1370 level was to traders. It's a huge level that had been talked about for some time. And I had my confirmation, which was the reading of the CCI, the Commodity Channel Index, below 100. Put all that together, and that is the mechanics of a wave reversal or a trend reversal, or this rollover entry, known as a wave CCI, wave reversal entry. Okay, and that's the short sell. We've hit two of the profit targets, so I want to talk a little bit about risk management now that we are on the plus side of this trade. And this is really important now. This is when we talk about not letting a winner turn into a loser. This is what this means in terms of how I look at the market. So when we set up this trade yesterday, we were just waiting. We're waiting for these events to happen. They did. Now you can see we sliced down through the first dotted green line. That was our initial profit target. Now what's so important about that is that's what allows us to take this risk-based stop loss here in red, that red line there, and move that to just above our entry. Now I'm going to use about just a handful of points above the 34 EMA low, because that was one of the entries. In fact, if I know 1370 was a big part of this, I want to put this maybe 1375, 1376, just above it. So more or less, it's a break even. Yeah, it's a few points above, but the idea of the break even is, would now, if prices just bounced up and hit 1375, would that represent a significant loss to my account? No, not at all. Not at all. It's not break even in the true arithmetic way, but it's break even in terms of I'm not going to let the trade get momentum against me in my position. So we've already realized a profit here at the green line. Now here's what's important. I don't know what your position sizing is, but here's your rule of thumb. Okay? If it's one lot, let's say you're taking a trade like this, and from a risk standpoint, the easiest way to make a trade affordable for your account size is change your position size. Too many people start sliding around the risk reward ratio. They start sliding around the profit target. They start cheating in a stop loss just to make the risk reward ratio work. Okay? Now, in terms of the slide from, again, let's head on over back to where it was. Okay? Now, I'm going to talk about some of the nuances of this trade that made it a little challenging. All right? I've been waiting for this trade for a while, because this is kind of, this and the dollar yen, which we'll talk about in a moment, were kind of the final pieces of a risk-off play that has been in the making with my very first Aussie yen short sell. So Whit had a perfect question, and I'm going to get to that. And I'm so glad you brought it up, Whit, because it really was a challenge in terms of taking this first profit target, and I'm going to talk about that in a moment. So let me go ahead and solid up this lower line here, because Whit brings up a terrific question. And this is, I always want a minimum of a 1-to-1 risk-reward ratio. And some of you might be saying, well, Raghee, the stop loss, your risk-based stop loss to your lower profit target is a 1-to-1, easily, if not a little bit better. Why did you take something off here at this minor support level? And the bottom line is, in terms of my wanting to be a little bit more aggressive with, and this is to everybody, I really wanted to be in a position to go and slide this down as soon as really I could to 1375. This is the kind of a laggard in my group of risk-off trades. It's the last one to have triggered. The Aussie yen was the first one to have triggered. The Aussie yen then turned into Aussie yen, Euro yen. Then we got the Dow. Then we got the dollar yen. And then we got the S&P. So in terms of that whole group of positions that are the common thread being risk-off, and this is the last one. So I thought to myself, well, I've been taking advantage of this theme for some time. I'm still going to be keeping this profit target open. I'm by no means done, but I wanted to be in a trade management scenario, not risk management scenario. Okay, and that's why I was a little aggressive on realizing some of my profit at that support level. That's why I drew both of them in. That's why I didn't leave this one only in place. Because quite frankly, if I was wrong about this, this is what I would have to sit through. And I probably was. I mean, I in terms of looking at a common number, I took some of the bodies of the previous candles, but it looks like, let me just show you here, that was going to be these previous highs back in here were going to be a better place. And that's the bottom line. We don't know where the market's going to find support or resistance. We can only look for different levels at which we can say, yes, we think, we hope this is going to be a decision level. So if I was up a little bit higher, I probably would have hit my second profit target too. The second one just fell short. So I'm glad I had the first one in place. In fact, we ended up closing right around that level, if you notice. So I know that from a profit target standpoint, that dotted green line really was a good choice. But the bottom line is we don't know which was going to be the decision level. That was my concern because we had just so much slot back here. I know it might be a little bit more convoluted a picture, and I didn't want to be still holding this position without having realized a profit, especially with the way we'd sold off. So I'm now in a position where I can say if nothing else goes right, I've realized at this point half of my positions gains now at that dotted line that we picked out together. Okay, then because I'm calling this a winner now, I will ratchet my risk-based stop loss from that area just above the 34 EMA low to basically what is a break even. Okay, and I'll just manage it from here. I hope we don't hit the break even stop, and I hope we start breaking down through the initial profit target and hit. I've adjusted this now to a level just above the 1350 area. In fact, our low yesterday was 1352. A lot of what I was maybe anticipating too much was that we'd hit the 1350 major cycle level, which is how you can see I just missed that second profit target. Usually prices have a way of gravitating to those whole numbers like 50, like 00. We fell just short, about 2 points short of it yesterday. So that was a lot of the basis of that placement, that 1350 major cycle level. I haven't given up hope on it, but I have to realize we're trading up at 1366. There's no reason that I should be in this position still without at least having lightened up my load. So I have half my position in the market right now. Okay, so I hope that answered your question. And that's what's happening on the ES right now because, again, we spent a lot of time setting this trade up yesterday with the whole build out. Now what? Some of you might say, well, Raghee, I didn't take that trade. No worries, okay? What can you do now? Well, the sentiment has shifted a little bit, not in a significant way, but we're moving up a little bit higher. And I'm going to take that move higher one of two ways. One is to wait for some clarity on the 5-minute time frame, because until my building block time frames, my 5, my 15, start showing some sort of up or down trend, so I can get like a downtrend like we had yesterday. That was between the greens, set up heaven, right? Right now, this is just kind of ugly, right? Little here, little there, little everywhere. Okay? It's mostly dominated by green grab candles, but it's really not taking me anywhere. Okay? So when I look at the 5-minute, when we want to talk about taking advantage of a between the greens environment, and I know I mentioned that briefly yesterday. Let me tell you what moving averages are on this chart. And by the way, gang, when I draw little arrows on here, can you guys see that? I wasn't sure if you guys can see little arrows when I draw them on the chart here. But what I'm trying to do with it between the greens, if you'll notice, there's 4 prominent moving averages here. Okay? And in terms of the moving averages, you notice 2 of them are green, hence the between the greens name for this strategy. The light green is the 13-period EMA on the close. The 13-period EMA on the close. So, I'll even just put this in here. 13 period, EMA, close. Okay? And that I'm going to put in that light green. Okay? The second one is the 21. And by the way, unless I'm using the 20, 50, or 200 period simple, I am all about Fibonacci-based numbers for my moving averages. Okay? So pretty much everything you're going to see outside of the 20, 50, 200 is going to be a Fibonacci-based moving average. Usually an exponential at that. Okay? Now the darker green is a 21 period EMA on the close. And that is the heart of the between the green setup. The light green and the dark green. That is the entry in an up or down trend. Okay? I like, I talk about how much I like having a visual cue. I probably could have called it between the blues. I mean, it doesn't matter. If they were light blue, dark blue, or whatever it is, I just have some sort of weird thing with green and red, huh? I guess blue would have worked just as well, but whatever it is, the light green and the dark green, that area creates the zone. And this is a 5-minute time frame. I do want to mention that as well. I do this exclusively on a 5. By the way, why do I want to do all this? Why is it such a departure from what I'm doing on the 15, 30, 60, 240 daily? The reason for that is, as we sprinkle a little educational goodness on our Forextra this morning, is because, think about it for a moment. How many candles do I get every day on a daily time frame? When I was setting up the ES daily, how many candles really did I have to contend with? 1. Back in my olden days, I'm going to date myself now, but back when I first started trading and my commodity charts were mailed to me, yes, mailed, this was pre-internet, I would sit down with a large paper, almost like a magazine of charts that I would have to update Monday through Friday by hand, and then I would get the new set of charts the next week, and then again update them by hand. So if I wanted to use an indicator or anything, I had to calculate it. But what was neat is I could pour through this book on Monday as long as I wanted, because not until later on that day would I even get my open high, low close to actually mark on my chart. So the time that I could take, the luxury that I had of that time, because I wasn't bombarded with intraday data, didn't have access to it, I would be able just to sit and take my time. Then all of a sudden, here comes intraday data. And I pretty much went from an end of day chartist to pretty much I think my setup back then was like a 3:13 minute and a 5:15 minute setup. I went from 1 candle a day to, on a 5-minute chart, 12 candles every hour. It was a significant shift in psychology and attention. So let me ask you, if you're looking at a 5-minute chart, and you might be looking across the dollar, the Dow, the S&P. I like also intraday trading crude oil, gold, cocoa, and sugar. Okay? And then I have my Forex pairs. Now I'm talking about what? Maybe 14 different 5-minute time frames that I might be looking at. I don't have time to be drawing Fibos, doing a lot of trend line drawing, doing a lot of nuance candle pattern type. I don't have the luxury of any of that, because I'm looking at maybe up to 14 different markets. Usually not that many, because gosh, I only have 2 eyes. But I could be looking at multiple markets, not to mention all my 15, 30, 60, 240 that might have trades that are setting up, which is, by the way, why it's so important, and I talked about this yesterday, to use those conditional orders. If you have the opportunity to park that pending order using a buy or sell limit order, do it. If you know the value at which you want to engage the market at, put it in the market. We did that a couple times yesterday. Even though the trade may not be triggering right now, you notice that I'm not a really active day trader, although I do have some day trading strategies. If my 240 or my 60 has a trade that I know where I want to get in the market, put that order in. Let that limit order sit out there and work for you. Don't just always execute at the market, especially if they're longer term time frames, if you don't have to, right? And I see a couple questions coming in about the between the greens and the rollover. I'll get to all those in a second, but I want you guys to think about why so many of these tools are kind of not automated, but why I don't want to do a lot of drawing and a lot of extra analysis, especially in a 5-minute. I just don't have that luxury, okay? So I have the 13-period EMA on the close. I have the 21-period EMA on the close. Then I have, let's add the other levels in here. I have the 34-period EMA on the close, and if you realize, the 34-period EMA on the close is the middle line of my wave. That's the blue line of my wave. So I kind of get some of my wave remnants here, so I can kind of keep an eye on what the angle of the market is in terms of the market trend. And then finally I have the 55 period. Again, all Fibonacci. I'm going to tell you real quick right now what each one's job is. So we already know that the 13 and 21 are about being able to proactively understand where my entry is going to be, maybe put in a limit order, but that is my entry zone. In a downtrend, it's my entry zone. In an uptrend, it's my entry zone. Remember, we're looking for bounces in a downtrend, pullbacks in an uptrend. Okay? The 34 is what I call my warning track. If I haven't started thinking about the side of the trade, which is maybe I could be stopped out, this is what that 34 is all about. If I want to cheat it and stop, you can consider the 34, but it's not always going to be something that I'm going to use. But the 34 is kind of to snap me out of the mode that most of us get into is, okay, where are we going to hit our profit target? Where are we going to, when is this trade going to work for me? This is trying to basically snap me out of the whole profit target, profit focus, fixation, and say, hey, this trade may not be going in my direction. Do I have my stop loss ready? Am I ready to go ahead and execute that stop? We're kind of heading in that direction. This is to keep me from negotiating my stop loss. This is to keep me adhering to the plan, which is if we hit the 55, and I'll put my stop about 3 in the Forex market, about 3 to 5 pips above that 55 in a downtrend, 3 to 5 pips below in the 55 in an uptrend. So just beyond the reach of it. That is the between the greens, and I execute this on any kind of market, stocks, futures, Forex, but it has to be a 5-minute time frame that is heading in a trend. That is the requirement. Okay? All right, so I had a question about the rollover. What are the tools for the rollover? The steps, I should say. Okay, so we're talking about a sequence of how we trigger that rollover, that reversal. It's 1, break the 34 EMA on the low, because this is a transition from an up to a potentially downtrend, or at least up to a broken uptrend. So 34 EMA on the low must be broken. That 50 DMA was right up in my face. I can't ignore that. So the 50 DMA break was part of our plan here. It's not always going to be part of it, but it was here. And again, 20, 50, 200s, especially on a daily, are very important to watch. So I will look at that 50 DMA and make it a part of my plan. If you remember back to yesterday, that's why we had 2 entry trigger levels. One was aggro, one was conservative. The 50 DMA was the conservative. On either one of those blue line breaks, the dashed or the solid, I need a reading on the CCI of -100 or greater. Price comes first. I cannot stress that enough, gang. I'm looking for the price break. I'm not even thinking about this subchart, this subgraph, this CCI. Not even thinking about that until I get my price break. When I get that, do I have the -100 or greater? In other words, -100, -101, -102. If I have that, boom, then I can go ahead and talk about triggering the trade. Okay, so that is the way we set that particular trade up. And by the way, one of the things I hope you're getting from all this is that every one of these strategies that I'm using is chosen not because that's what I want to do. It's chosen because that's what the market is telling me to do. And by that I mean the market is telling me by my first stepping back and saying, what is the underlying market trend? Not only on the daily, but then on the specific time frame that I'm setting up. So the choice of strategy, gang, ask yourself right now, and maybe a little homework if I could give it to you. Ask yourself right now, of all the different strategies that I have at my disposal right now, number 1, which are, for example, trend following? Which are ones that take advantage of a trend reversal? Which are ones that take advantage of, say, momentum breakouts or breakdowns in a sideways market that's coiling, right? Which ones take advantage of exhaustion within a wider range? I mean, the market can really, and this is a la Charles Dow right here. This is how much Charles Dow has absolutely influenced the way I view the market. Am I looking at an uptrend? He would call a markup. Am I looking at a downtrend? You can call that a mark down, although he doesn't talk a lot about that, but mark down. Am I looking at a wide, volatile, sideways range? That's a distribution market. Am I looking at a narrow, quiet, sideways range? Lower volatility. That's accumulation. So the market can either go up, down, reverse the trend, chop around in a wide trend, or consolidate in a narrow, I shouldn't say chop around in a wide range, and consolidate in a narrow range. That's all the market can do. So I need a strategy for each one of those personalities, if you will, or as Charles Dow would call them, phases of the market. So, possibly one of the most important things I ever did was to sit down and ask myself, of all my strategies and the indicators that I use, in which phase do I use them? Because, again, the choice for using between the greens comes first from, do I have a trend on the 5-minute time frame? If I have a trend, then I can go ahead and use that strategy. The choice of using that rollover yesterday on the ES was coming from, I have a trend that is transitioning. It's basically no longer an uptrend any longer. Is there a chance that we might get some weakness and some pressure on all the reasons that the uptrend was in place? Because if I pressure those reasons, I might get a trend or wave reversal. So again, it's what the underlying market is doing that makes me choose one of the strategies. I just don't, you can't just throw spaghetti at a wall, right? So let's jump on over to, oh, by the way, I did mention, for those of you that are thinking, well, if we're bouncing on the ES right now, what are some of the options for the market right now? I mentioned the between the greens, which is not really coming into focus. I will look at the 4-hour. The 4-hour is positioned in a very unique place in terms of a couple entries, because right about the time that I may be questioning whether or not I want to hang on to my daily rollover short of the ES, I'll be hitting resistance at the 240-minute downtrend. So this is going to be not only very important to the exhaustion that I need to hold on to my short and possibly see follow through on that daily ES, here's where the 4-hour could trigger. Okay, the risk reward ratio is pretty good here. Okay, I know it's a little bit of a longer term time frame. I'm going to put my stop loss just above that 80 area, minor psychological level, above the 200 period simple on the 240, above the 34 EMA high, again on the 240, and that would be my stop loss. Okay, I'm just drawing this in here real quick. And you can see this is kind of a common level, that 30, basically 84 area that I'm putting in, because it's just above the minor psych, which I love. And there was previous support here, actually just below this even. So this was once a meaningful level or area to the bulls. They treated it as support. Moving forward, it could be then a common level where it could be resistance. What was once resistance becomes support, or in this case, what was once support is what I'm gauging to eventually become resistance. And I'm using a couple other reasons to make that level more significant as a decision level with the minor psych, the 200 period simple, my 34 EMA high, etc. So that would be my stop loss, my profit target. Don't ever expect a market to make a brand new low just for you or me or anybody for that matter. I'm going to put my profit target at about this area right here, maybe even a little higher, because if you notice from the risk reward standpoint, I do have the luxury of maybe a little bit more of an aggressive level here, and I'm going to put that in. So those are my levels for the 240. Again, if you're not in the daily, that's cool. I'll be watching this one anyways because it has a lot of ramification for my daily. Okay, let's jump on over to the Dow. And by the way, while we set a lot of trades up in the ES yesterday, my real love is trading the Dow. I really love trading the YM contract. I know a lot of people love the ES. They more or less do very similar things. But my real love is the Dow. I find that, some of us probably step back and say, gosh, there's certain markets that I just really pitch and catch with well. And the Dow just happens to be the one for me. I spent a lot of years trading that ES, and before that the SP. And then when I got the DJ and then the YM, I'm like, wow, I think I just have the rhythm of this market that much better. Okay? So when I look at this Dow, by the way, you can see this is really just a little further along that same setup we had in the ES. So you can see here my profit targets are being reached. Let me just zoom in here a little bit because this is at another important level. We talked about how we wanted to ratchet in from the risk-based to the break-even on the ES. Well, here's a situation where I've ratcheted in already from a risk-based to a break-even, and now upon hitting really what is the second profit target here, I'm actually in a position where today I'm going to decide whether I want to go from the break-even, which is the red line you can see there, to a trailing, which would mean moving this red line here, which was just above my aggro short entry, to just above this area of my initial profit target support level. So ratcheting has three phases. We have really three kinds of stops. Our initial risk-based stop, which really should represent some sort of point of validity. In other words, my stops are based upon this idea of where is this trade no longer valid? Where is this trade no longer any good? That does, in many ways, assume that you know why you're getting in the first place. So if I'm waiting for my wave support to break, when the wave is no longer resistance, that's a pretty good level at which I can say, yeah, wave resistance is not holding. Well, there goes my validity for the trade. So in terms of how I'm placing that stop, again, I have to ask myself, I think, what is a very difficult but simple question. Difficult to answer because it really assumes that you know why you're getting in, which is where is the trade no longer valid. That's why I'll call that risk-based stop my point of validity. Okay? For me, a stop loss in my early days was something I could negotiate because I didn't use this idea of this is where the trade is no longer valid, dummy. That's the conversation I have to have in my head. Think about your early years when you're not quite as disciplined as you are now, right? When I said, oh, it's a stop loss based on 40 pips or ticks or whatever it is. Well, why not 43? Why not 45? Why not 50? For me, to follow it with discipline, it had to mean something. If I say that is my point of validity, the trade is no longer valid, I feel like a fool hanging on to it beyond that point. That's the mental game I have to play with myself because we all have the pig in the head, right? The little voice that says, oh, just give it a few more pips or ticks or points, right? So for me, having that point of validity look me square in the face saying, this is where the trade is just garbage beyond this point for you. It meant something to me. I had a whole lot more discipline. And that's a trick that I learned early on in my career. Knock on wood, thankfully. So now what I'll do is I'm hitting my second group of my second profit target area. I can move in from the break even. I'll ratchet it again to now a trailing. So I'm going to protect this position. That's the whole idea. And that's how I'll do it. Now, depending upon how aggressively you like to protect your position, that's really going to dictate the pace and the rhythm at which you begin to ratchet your stop. Again, three types of stops: risk-based, break-even, trailing. We all like to be in that trailing position, right? Okay, so that's the YM right now. The YM probably has a very similar setup to the ES on the 4-hour. And, the 4-hour, my only hesitation for the 4-hour right now is we don't really have a concrete downtrend. I have a lot of bearishness. I have a lot of that pessimism here, but I can't look at the daily and say that my directional bias is really bearish enough to call it a downtrend. So the longer term time frames, I get a little hesitant. In that kind of transitional or fresh downtrend view, I'd rather focus on short term, 30, 15, 5. But that 4-hour really has a nice, clear market trend, and the same type of setup that I set up on the 4-hour ES with the 20-period simple and the 34 EMA on the low, I could probably do the same thing with the 4-hour YM. I'm just sliding these down here. And remember, these are dynamic values in terms of the entry. Our profit targets and our stop losses are, well, profit targets are static. Our stop loss, depending upon whether it's the top line of the wave or a moving average or some sort of price level, could be dynamic or static. Okay, so make sure you understand whether the levels you're watching are dynamic levels or static. For a swing entry, they're always dynamic. But on a 4-hour time frame, I'm really not concerned about the moving average making a really significant shift, but once every 4 hours. That's kind of a luxury of the slower intraday time frame there. Our dollar, by the way, continues to be doing absolutely nothing, chopping around. One of the reasons this is working so well in terms of especially in terms of the risk off and why my dollar yen triggered yesterday is that basically the slippery slope that starts at 80. It's not that it's a level at which the prices just get whack-a-mole, right? This isn't where the bears are just whack-a-moling the market. It's not like it's just completely disintegrating. It's just that it can't keep any footing, it seems, between 80 and 80.30 on the dollar index. And the dollar index essentially is not going anywhere. You notice it's just congesting within this triangle. So I have no directional bias here. And quite frankly, I don't like to trade markets that are in a chop on the daily. Okay, so I'm really not doing a lot here. If there is going to be any clarity, I just assume focus it on the between the greens on the 5-minute for this chart. Okay, and just like that, I need to at least head on over to the Forex. We can talk about that for a little while. So I'm going to jump on over to that chart, that set of charts, I should say. And here we have our view here. And by the way, a couple platform questions coming in. While I'm answering those, I just want you guys to have a little bit of a feel, and I'm going to really, I apologize, but I just want you guys to see this because I think it's kind of important. I mentioned that the view we're looking at for the webinar is really one half of one screen. What I've got, just so you know, on the other screens, so I'm going to show you here real quick, and it's going to change your view pretty dramatically because my monitors are set up vertically. Okay, they're all the monitors that I have sitting in front of me are not horizontal. They're not in a landscape. They're in portrait. So the view you're seeing right now, that's the view I have. 8 charts across multiple monitors. So when I'm looking at and I think this is a very important point to make, the scanning process of my looking for a trade really involves looking simultaneously at one symbol. I don't care if it's the ES, I don't care if it's COCO, I don't care if it's a stock, I don't care if it's the YM or a Forex contract. This is the dollar yen in front of you right now. I don't care what the symbol is. The main point here is to remember that I want to scan them all simultaneously so I can see my daily's directional bias in a glance. So I can see the individual market trends in a glance and find out where the clarity is at. That is how I choose the time frames I'm going to trade. And it makes it very easy when all these time frames are in front of me simultaneously. You know, I do look at multiple time frames because sometimes there's such very little organization that I can't get any clarity out of, say, my 60, 240 or daily. Yet maybe my 5 and 15, because of the narrow range and because of the near-term organization, are looking great. Sometimes there's a lot of near-term chop, a lot of noise in the near term, yet my daily time frame might be just trucking along in its typical price movement range. And this brings up so many other points that I wish I had the time to discuss with you all, but we get down into concepts like trying to understand the typical price movement range of an individual, let me head on over here, of an individual pair. So let me switch your view again, and I'm going to show you here real quick. So this is for those of you that are kind of into the Forex market. This is a very cool look at how the market moves, the behavior of individual candles, and also the behavior of different pairs over time. Okay, so we're just going to stop on over here real quick. This is called Power Stats, and I'm going to just pick up the most popular pair that people look at, which is the Euro-US dollar. And I'm going to pull up the Euro-US dollar, and what we're going to do, and I want you to think about just for a moment, and we'll tackle some questions here, is what is the rhythm of the pair? Because stock and futures traders know, especially if you're a day trader, you already understand this whole concept of the rhythm of the market. You know, you have the open and the clearing, and then the 10:15 and 10:30, then lunchtime, then the doldrums, and 2 o'clock comes back, bond close, market close. You know, you have a rhythm of the day. You know, you can pretty much tell based upon what time how the volatility is going to behave, right? Well, in Forex, I have multiple financial centers and a 24-hour market. So take a look here at this first graph in front of you. This is the expected price range over the course of the next 15, 30, 60 minutes, 4 hours. So this is part of my trade build out that we really haven't seen yet because we just don't have the time. But part of this is understanding where the market could go given 15 minutes or given an entire day. The range of the day is going to be obviously much wider than that of a single 15, 30, 60, or 240 minute candle. Okay, but this is where I really want you to understand for those of you that are kind of just venturing into the Forex market. The rhythm of the trading day. Don't look at the hours between 8 and noon and expect that same kind of price movement between 8 p.m. and midnight. You are going to be really shocked by it. Because what happens is between 8 and noon, you've got New York, you've got Paris, Frankfurt, London, right? 8 p.m. to midnight is a completely different discussion because now we're talking about the Asian session. And you do have Sydney, you do have Tokyo, Hong Kong, Singapore, yes. But just take a look at the difference between 8 and 12. This is a 24-hour clock based on Eastern Standard Time. So look at the numbers 8 through 12, and then look at the numbers 20 through 23, even 0, which is midnight. Look at the difference in movement. The average is the band across each one of these bars, and the bar itself represents a high to low range. You can see your pips here on the left-hand side and your time across the bottom. Okay? And this is the rhythm of one pair. You have to know the rhythm of the market you're trading. Doesn't matter if it's Forex, futures, or stocks. You've got to know the rhythm because the volatility will shift. And the reason you have to understand the volatility is that's going to be part of your whole risk reward. It's going to be part of what kind of risk tolerance you need, etc. Okay, so on to our Forex. And our questions, which is, we talked about the EMAs on the 5-minute. Why do I use the 240 instead of the 60? Again, Rick and everybody, in terms of time frame selection, I hope I've tackled that a little bit. It's really about finding market clarity. It's really about my using the wave and my grab candles and asking myself, where do I have a clear markup, markdown, accumulation, or distribution market? Can I recognize one of those clearly using my wave and using my 30 and my grab candles and say, okay, I've got a downtrend here or an uptrend here? Which one of the time frames seems to be reflecting the clearest psychology? Because that's the one that I want to focus on. And the clarity really is a culmination of my grab candles and my 34 EMA wave. And that's how I, basically what I call triage a symbol across multiple time frames, choosing the time frame that I think is giving me the clearest psychology and therefore the one that allows me to pick my strategy with the most confidence. Okay? So it's not a matter of my liking one time frame versus the other. In this case, look at the dollar yen. You know, we had we talked about this short yesterday too that accelerated. This breakdown was pretty much the same exact breakdown we talked about on the ES. This one's following through as well. If you're not in this short right now based upon the daily rollover, you can look for a setup on the 240-minute time frame. Why do I like the 240? It's heading down clearly, consistent red grab candles. The 60's heading down as well, but it's not as nice what I call a 4 to 6 o'clock angle. My 30's starting to chop. My 15's chopping. My 5 may be a between the greens candidate, but it's not really looking healthy in terms of a nice 12 to 2 o'clock, smooth set of moving averages, established. There's a lot of criteria that go into my selecting one time frame versus the other. We're just kind of diving into the setups here today. For those of you that are not in the dollar yen, here's another set of limit orders you can park. In fact, I've already parked these in the market waiting for some sort of correction. A lot of my order entry, gang, because some of my setups are going to be on the longer term time frames, are just parking limit orders. So the 20 period symbol, I've got a limit order to sell already waiting there. My only job now is simply to wait when we will get that bounce, that correction. A lot of that correction is going to be based on a little bit of near-term, maybe profit taking, a little bit of near-term hesitation about whether or not this dollar yen really is bearish, because we are at the most vulnerable part of the transition. The people who are bullish still might be clinging to a little bit of that bullish thought, strategy, hope, right? The people who are bearish are fighting that bullish strategy and expectation and hope, right? Now, because we have two groups of participants that are basically butting heads at a moment in time where the market isn't quite bullish anymore, but it's not established enough to be a downtrend, to be bearish, there's going to be a wide range of opinion, a wide difference of strategy. Some people might be looking at this 80-50 level saying, all right, that's a good correction, I'm going to get long again. Might be. Some people are saying, hey, this is where the bounce might occur, and I want to get short on a bounce because the sentiment and the momentum are turning into a downtrend. I'm not quite there yet, but I'm definitely more in the bearish camp, and the 240 might be a great way to take advantage of that by shorting into the 20-period simple aggressive and the 34 EMA low, which is my conservative. So I've got my pocket entry, my zone, if you will, my swing short zone. The swing is the correction that I need. The short is going to be my reaction. I want to short when we get up in here. So for those of you saying, well, okay, this thing's left without me, what are my choices now? If we do clarify into a swing short, I will say the 5-minute could continue up higher, and I might actually have a one thing leads to another scenario. I could between the greens buy the 5-minute if it clarifies and ride that higher into the resistance of the 240 zone. So that's a one thing leads to another. Very, very near-term strength could carry up into the resistance of the swing short zone on the 240, which would maybe not be quite trend following, but much more in terms of current sentiment and momentum following, okay? All right, my entry on the ES between the greens, solid blue, okay. Going back to the ES, sure. Let me jump on over there. I got a question about that ES entry. Okay, in between the greens, so head on over to the 5. The question was, and actually we didn't have one because if you remember, this wasn't a uptrend yet, right? But the question is, I don't think we had one on the 5. We didn't have a between the greens entry on the 5. We had one on the 240. And yes, my swing short will be waiting between the dashed blue, that's aggressive, and the solid blue, that's conservative. So it's the 240. Okay. Does this pullback look similar to the one from September, October? Was that, if you let me know which one of the markets we were looking at there, I'll be happy to jump back on over there. Okay. Okay, in terms of the CCI versus the RSI versus stochastics, gosh, that's a huge question, but let me see if I can just answer it as succinctly as possible. Unfortunately, succinct is not my forte. All right, so the reason is, ask yourself, what is it that you're looking for? My choice of indicators really came from, I need to see momentum most of the time. So the CCI shows me the momentum on say, a market reversal, like what we were looking at here on this S&P, this ES contract. The CCI shows me that bearish momentum. I could very well use an MACD too, because I do use that for momentum, but the CCI is a little bit more choosy. The MACD would have confirmed this breakdown as well, probably a little earlier, but I like the CCI because it's a little bit more choosy a filter. So I like to focus on the CCI, but it's really about momentum for me. I'll use the stochastics when I'm in a situation where the market is oscillating, when the market is going back and forth within a wide range, and I'm looking to try to capitalize on exhaustion levels within that range. For momentum, the stochastic is pretty lousy. Its job is, for me, in my opinion, to identify those levels where the market's going to exhaust. So I need to find a market that's moving sideways in a wide volatile range, and then I'll use the stochastics. That's where I find it excels. That's its environment. Because you'll notice, in a trending market, a stochastic is always going to think an uptrend is overbought. Well, in my opinion, there's really no such thing as overbought in an uptrend. Okay, and in a downtrend, the stochastic is always going to think we're oversold. Yet we'll be persisting with lower lows and lower highs, and the stochastic is going to continue to say, hey, we're oversold. So it's a great tool, but it's applied to the wrong market phase if I try to use it in a trend. So first of all, make sure you know what your indicator is trying, or what you want from it, and what it's designed to do. The CCI and the MACD for me are really momentum indicators, and that is a little different, but that's what I found works best for me. So I choose the indicator based upon the strategy, and the strategy is based upon the underlying market trend, the underlying market psychology. Okay, my 34 EMA settings are based on both the long and, yes, none of my indicator values will change for buys or sells. The indicator values that I've shown you, that's the way they always are laid over on my charts. They never change. So I will use those same values. So in the case of a wave reversal, let's say we had a wave reversal to the upside, I just use the opposite side of the wave. So rather than a break down through the low like we had here on the S&P, if this were a downtrend transitioning into an uptrend, then I'd be talking about the 34 EMA high, maybe the 20 period simple. Okay? So it just would be working off the opposite side of the wave. Ask yourself, which was was it acting as support or resistance? In this case, in the uptrend, it was acting as support. So a break of support would be the wave losing its grip at the 34 EMA low. In the case of resistance, the wave would lose its grip as dynamic resistance as prices pierce the 34 EMA high. Okay? All right, that question was on the YM. Sure, let me jump on over there. Okay, so in terms of the YM, the question was, does this pullback look similar to the one from September, October? Let's squeeze in some market memory and take a peek. And my September, October, let's take a look at the, everything is really based upon the market phase. And yeah, I guess you could say at that point in time, when we broke the 34 EMA wave, although look at the preceding price action. Yes, we were breaking the wave, and mechanically, this is the same type of thinking. But look at the trend that preceded the wave breakdown. It wasn't very much of a trend, right? It hadn't been heading up for very long. Versus what we have now, which was basically moving up since the end of November, now to the beginning of April. So we had a move that basically started going green on the grab candles on, this would have been, I'll give you the exact date, October 11, and we started going neutral on the grab candles to red on October 21. So we're talking about a much shorter period of time before the wave lost its grip versus here where it was, over 3 months. So the actual mechanics, yes, but the preceding trend is what I think makes it a very different setup. Okay? All right, so I really do want to take a quick peek at the Forex before we have to part ways here. And I'm going to jump on over to my MT4. Oh, is it the wrong MT4? Let's make sure I pull up there we go. My MT4 here. And we talked about the dollar yen here real quick. Let us jump on over to take a look at the Euro US dollar here quickly. I have not been doing much with the Euro US dollar. Okay, the reason being is it's in a chop. But this is a good example because it was a question about the stochastics to talk about when I would use the stochastics to gauge overbought and oversold. There is so much pessimism right now in the euro. I am not saying that we couldn't head down. I mean, there's been talks of parity. I don't know. Yesterday, I had a guy on CNBC who talked about parity. And, he said, admittedly, he oftentimes is too far ahead in terms of his calls. I'm not disagreeing with anybody who says 1.4 thousand. I'm not disagreeing with anybody who says parity. The bottom line is we have to get out of this range before we even see the next leg of movement. Am I more of a pessimist? Sure. I mean, obviously we know what Europe is struggling with, so it'd be very difficult for me to get bullish here. But based upon what the market knows and is reacting to right now, it's really not breaking out of the range, is it? When you hear about all this pessimism, and this is a really good way to understand the effect of fundamentals on your trading. Making a call for parity based upon what's happening in Europe is a fundamental call to me. Anytime I hear a story, whether it be data driven, whether it be someone making a call about parity based upon the struggles in Spain, coupled now with the issues in Greece, although they are two different stories, and that's a topic for another time. I can only gauge the way the market is reacting to that by looking at price. And if people really were in an absolute panic about Spain, we'd break down out of this range, wouldn't we? We're not happy about it. Obviously, we're trading down near the lows of the range, but we haven't broke the range, have we? So I find it very interesting that people are projecting so far ahead when, in fact, my job as a trader is just to gauge what I can actually see the markets reacting to now. I'm not a fortune teller, right? I'm a trader. It's not my job to go out there and make these big proclamations about where I think the market's going to be in 14 months. To be honest with you, and I guess it depends on your outlook, that could concern me less. I could care less where the market's going to be in 14 months because I'm going to trade it along the way. So parity, I could care less. If we're going to get down there, it's going to trigger a series of trades across multiple time frames, and we'll have different plays on the way down there, right? So, whenever you hear anything really royally pessimistic about the euro or optimistic, just say, am I breaking the range that this market has created through the price action we've seen through basically mid-January to now? With the exception of a couple of times where we poked up above, okay, we'd basically be within the parameters of these red and green lines that I've drawn on this daily. So because of the sideways range, the lack of any kind of directional bias, I could use the stochastic to say, yeah, I'll buy in this area. I don't like doing that a lot. I'm not a big fan of exhaustion trades, but at least I understand the parameters of the market's indecision. If I am going to trade this market, it's going to be short term, 5-15 likely, maybe 30. And if you think the market's going to be bouncing up off the bottom of the range, between the greens on the 5, maybe some swing buys that are setting up on the 15 and 30 might be the way to go, because we're coming off that support level, heading up higher. I'm not going to assume longer term organization. I'm simply going to look for opportunities to play short term time frames off what I feel a bounce off a floor. Very soft floor, okay? But I could play the bounce off the floor by swing trading the 15-30. And by the way, the between the greens is basically a swing trade as well. Okay, so again, if I didn't get to any of your questions, real quick, the MACD settings are 12.26.9. Basically those popular default settings. If I didn't get to any of your questions, again, my apologies. I will see you guys tomorrow here back in the chat room for the Forextra Hour. Thank you so much for your time and attention and questions. Great discussion, gang. And without any further ado, here's Rob.